Hello, everyone, and thank you for joining us for this month's KJH Insights podcast. I'm Joel Clark, Senior Portfolio Manager at KJH Investors, pinch hitting for Sarah Bull this morning while she's away. As always, our goal of these conversations is to help clients make sense of the market environment and understand how we're thinking about protecting and growing capital through changing market cycles. I'd like to welcome Andrew Csumrik back to the podcast today. Andrew is a senior portfolio manager and a key member of the KGH investment team. Andrew, great to have you back on the podcast.
Yeah, thanks, Joel. Happy to be here. There's a lot going on. Looking forward to getting into it.
Why don't I kick off right away, Andrew? After 9 consecutive weeks of gains for the S&P 500, markets have softened over the past week or two. What's driving this weakness? Is it concerns around the conflict involving Iran? Is it inflation data, interest rates and bond yields, or perhaps stronger economic data raising questions about the Federal Reserve's next move?
Yeah, I think you've hit some of the main points there, and really the market did have an incredible run, and we've seen some softness, as you mentioned, over the last week or two. I think that's normal to see some digestion after that. So the first thing people point to, because it's, I think, just so headline worthy, is the situation in Iran and broader Middle East. And yeah, the news flow has been relentless. One day it looks like a ceasefire, the next day there's an escalation. As we're recording this now, it looks like there's apparently a deal in place. So we've just kind of been dealing with this for months now. And so that kind of uncertainty does weigh on sentiment. But I'd say that's a bit of a background factor, and it creates a lot of headline risk and volatility intraday. But it's not necessarily the primary driver. What I think really spooked the markets is inflation and interest rates. We've had a couple of inflation prints coming in hotter than expected. And I think the market still has a lot of anxiety around inflation. If you think back to we went years of fighting it and investors hadn't fully gotten past that. If you think about even the post-COVID environment. So when you see a number that's a little hotter than expected and going in the wrong direction, I think the reaction is there. And tied directly to that, yields have been rising. So when interest rates go up, generally there's two things. You increase the cost of capital for companies, which directly impacts valuations, and it just tightens financial conditions across the system. And you're very well aware, globally there's an enormous amount of debt. You've got governments, corporations, consumers. So when rates rise, it really impacts the entire system. And you touched on good economic data, which, normally that would be a good thing. We saw over 170,000 jobs added last month in the US compared to, I think, around 80,000 was expected. We've had jobless claims that have been consistently near record lows. And so most environments that would be applauded, but we're in somewhat of an unusual period where this good economic data is being treated as bad news, because if the economy is running hotter than expected and inflation is sticky, then the Fed may not cut rates. And we saw that really over the last month or two, the market's starting to price in the possibility that the Fed might actually have to raise rates again. And so that's a different backdrop than what most were expecting around 6 months ago. So you've got kind of this weird situation where the economy is strong. That's great fundamentally, but it removes that safety net of rate cuts that a lot of investors were counting on. So I'd say, yes, the war in Iran is in the background, and that volatility and uncertainty is there, but really this inflation anxiety, interest rates, and tied to that, maybe where the Fed is heading has really been what's kind of spooked the markets.
Well, and of course, we know Trump desperately wants rates lower, and Warsh is in, the new Fed chair. I think he has his first meeting next week. So that puts them already at odds with each other. So I'm sure that's why Trump wants to deliver some resolution, because he needs that to happen before rates could ever get down.
Yeah, and I think that's a big part of there being so many moving pieces to not only geopolitical events, but financial markets. I think, yeah, the longer that this goes on and the longer that oil prices are higher and inflation keeps printing the way it is, it's pretty hard to get interest rates lower. And I think that ties into that strong labor data. The Fed would have to basically point to something to cut rates. And before, it was kind of the labor market had been weakening and weakening. But if you have
Yeah.
hot inflation and a better jobs data, there's really no catalyst there to really be cutting rates. And so you can want lower rates, but in the current environment, I don't think that's the direction unless things change.
Yeah. Moving on to the topic du jour of the day, one of the biggest topics investors seem to be discussing right now is the wave of potential mega IPOs. And of course, we have SpaceX this morning. And beyond generating significant fees for investment bankers, what do these offerings actually mean for investors and markets today? Beyond SpaceX, we have OpenAI, Anthropic. They're discussing going public with unprecedented valuations. How should investors think about these companies and the impact they could have on markets today?
Yeah, it's definitely topical. We've never seen anything like this in the history of capital markets. We could potentially have all three coming with $1 trillion valuation, depending on where things line up, which just seems insane to think about. But I guess the first question that a lot of people ask is, does this suck, liquidity out of the rest of the market? Can it absorb these massive companies coming to the market? And the answer is kind of nuanced. I'd say somewhat it is a problem. When you have these massive offerings, capital does get redirected, right? If you want to participate or you want to have a weight in one of these, you generally need to sell something if you're an index player or if you're a fund, you're not sitting there just with a ton of cash, and so something else needs to be sold to fund it. But I think it may not be as drastic as most people think, and the real reason is distinguishing between a market cap and a float. So if I touch on that, just because a company has a $1 trillion market cap, it doesn't mean that $1 trillion of stock is available for trading on day one. So the float, which is what it's called, the actual shares that are available to the public, is typically a fraction of that total. So as an example, SpaceX is raising 75 billion today. It's expected they'll have around 1.75 trillion market cap. So that's around 4% of the total market cap that the market has to absorb. So it's not almost $2 trillion. It's the 75 billion. So the immediate liquidity impact, it's real, but it's more modest than most headline numbers would suggest.
And this sort of ties to the follow on question, which is something you and Peter have been discussing frequently during our investment webcasts and updates, which is really the changing makeup of the S&P 500 index. Historically, it's been viewed as a very broad and diversified representation of the US economy and global corporate leadership. How has that changed over the last couple of decades? And again, what does it mean for investors and clients today?
This is something I'm pretty passionate about because I think a lot of investors don't fully appreciate how much the index has changed. And this is specific to the S&P 500, but there's also others out there. And I've done work on going back to the late 1990s or even the mid 2000s. The S&P 500 was very well diversified, as you mentioned. You had meaningful representation across financials, industrials, healthcare, energy, consumer. It was really a broad section of the American economy, and not even just the US. Roughly half of the revenue generated by the S&P 500 came from international markets. So it was a great proxy for global economic activity, backed again by strong US accounting standards. If some people want to invest internationally, you run into those risks. And it was a deep liquid financial system. So we always said that it was the gold standard of indices. But today, that's not really the case, and especially where we're heading. So technology and AI related companies make up over 40% of the index. So already that is a drastically different makeup than what we've been used to. But I think just on our last topic here, if SpaceX, OpenAI, and Anthropic join the S&P 500, which they will, that number goes above 50%. So more than half of the index would be concentrated in one theme, whether it's technology, artificial intelligence. And we think that number can go even higher because it's not necessarily a bad thing. These companies dominate in the fastest growing part of the economy and they're generating enormous revenue and profits. So the market is reflecting that reality. It does have implications that investors really need to understand. Owning the S&P 500 today, whether it's an ETF, an index fund, you're making an inherent bet on AI and technology, which you may not realize. And it's making a lot of other industries, the ones I mentioned earlier, increasingly irrelevant in that index. So our message really there is knowing what you own, understanding what you're actually exposed to, passive investing is a strategy, and there's not necessarily anything wrong with that, but think of it as being diversified, but don't confuse that. It's not the same the way it used to be. So it's a very different animal than it was even 10 years ago.
So maybe last question before we sign off. Always lots of things to worry about. It seems every podcast or market update, there's something in the immediate short term to be concerned about that's legitimate, but markets have climbed the wall of worry. So what gives you confidence given everything we've outlined from the war to rates to inflation? What gives you the confidence about your positive outlook on the market continuing?
I think that's a really good point. We're always hardwired to being looking around the corner. What's the next thing to worry about? And there's always risks out there, like you mentioned. But I think right now, if we're trying to be positive and what could move things higher, it's earnings for me. That's the story right now. Earnings growth this year, which we haven't touched on. And I think sometimes it gets left behind with all the macro headlines. It's been really impressive. Part of that has been driven by AI in the tech sector, which we've spoken a lot about, but it's not only that. The broader US economy has been really resilient, especially in the face of higher energy prices, like the K-shaped economy, geopolitical events. Consumer spending has really held up, and corporate balance sheets are in great shape. So we're starting to see signs that growth in the US economy is actually accelerating from the companies that we've been talking to. An area we focus on is ISM manufacturing, and that's an index that basically is forward looking, and it asks the manufacturing sector if they're expecting expansion or contraction, and that index crossed above 50 for the first time in years this year. And that's significant. Above 50 indicates expansion, below 50 indicates contraction. So we've moved from a manufacturing sector that was shrinking to one that's growing again. But I think the number that I really want people to focus on is earnings growth so far this year has actually exceeded the market's price increase. So today, the S&P 500, it's up around 8.5%, depending on when we're looking at it. But the change in earnings is up 15%. So if you think about what that means, the market's gone up, but the profits behind it have gone up even more. So on a valuation basis, the market is actually cheaper today than it was a year ago, even though stock prices are generally higher. And we think that's a healthy dynamic. And so if we get some kind of resolution, we saw that yesterday as we record this, it was a big market move. I think S&P was up 2%, Russell 2000 up 3%, just on the discussion around a resolution in the Middle East. Oil prices coming back to a more normalized level, and you combine that with the earnings momentum that we've been seeing behind the scenes and the U.S. economy having real underlying strength. I think that's a pretty constructive setup. And as you mentioned, I'm not saying there aren't risks, but the fundamental backdrop with the actual profits that companies are generating is solid. And over the medium to long term, we always say that's what drives markets, not the headlines, not the day-to-day noise. It is earnings. So that's kind of what we continue to focus on, owning businesses that compound their earnings over longer periods of time, and generally a much better use of our time than trying to call day-to-day moves in the market.
Yeah, that's impossible. I saw a funny video last night that 38 times that Trump said since the beginning of the conflict that they had a resolution on a deal. So,
Yeah, yeah, and I think just on that point, the market, as everyone tries to figure out day-to-day moves, the market is smart. And I think if you've noticed, those tweets have generated diminishing returns over time in terms of the volatility that goes after it. I'm sure you've seen people are both ways, right? Whether it's escalations or de-escalations, people are kind of saying until we see something concrete, it's moving a lot less than it was
yeah.
early on. And I think that's also a healthy thing too, because people are understanding he's kind of flipping constantly.
Great. Well, thank you, Andrew, as always, for sharing your perspective. Our clients really value your insight and your ability to bring clarity to what can often be very complicated market environments. I'd also like to thank everyone who joined us today. If today's conversation raises any questions about your portfolio or your wealth plan, please don't hesitate to reach out to us. We also enjoy hearing from you and discussing what's most important to you and your family. We look forward to speaking with you again next month. Enjoy the beautiful weather, stay well, and thanks again for listening.
This podcast is produced solely for informational purposes and is not to be construed as an offer to sell or the solicitation of an offer to buy a security. The information herein is based on sources we believe to be reliable but is not guaranteed by us and does not purport to be a complete statement or summary of the available data. Any opinions expressed herein are statements of our judgment on the recording date and are subject to change without notice. Any unauthorized use or disclosure is prohibited. Receipt and/or review of this presentation constitutes your agreement not to reproduce, display, modify, distribute, transmit, or disclose to others the content, opinions, conclusions, or information contained in this podcast.